that said, we look forward to hearing about your venture capital.
Perfect. Hello, everyone. Thank you so much for the organizers for including our paper in the program. My name is Guilherme. I'm a PhD candidate at the University of Florida. Really a great pleasure to present today my paper co-authored with Murillo Campello, who is also at Florida, for a paper titled Tax Incentives and Venture Capital Risk-Taking. So here's the story. Tax policy is commonly used as a way to promote entrepreneurship. There are such programs in many countries across the world, including France, Singapore, Israel, Brazil. Over 100 countries use tax policy to promote entrepreneurship. But the way that these programs usually work is that governments provide these tax subsidies directly to companies. Most countries lack a developed entrepreneurial finance market. But in the United States and in a few other countries that have very developed entrepreneurial finance markets, the governments provide these tax subsidies to investors backing startups. When we consider these startup investors, especially when we're talking about venture capitalists, these are highly sophisticated investors with strong screening and monitoring capabilities. So a question that emerges is whether providing tax subsidies to these sophisticated investors with risk tolerance actually improves capital allocation in the economy, or only provide opportunities for these investors to make additional profits within existing investment strategies without backing more firms. That's such a lot of debate in the United States, where tax expenditures on this program specifically are over $4 billion a year. And opponents to these tax subsidies being provided to startup investors tend to make arguments similar to what Bloomberg Businessweek highlights in this article. When an 8-figure IPO windfall can mean a zero-digit tax bill. Similarly, the New York Times highlights a lavish tax dodge for the ultra-wealthy is easily multiplied. So the core argument of opponents is that the startups themselves don't benefit from these tax subsidies. Only the investors do. We don't have more companies in the economy receiving funding because these tax subsidies are available. But the investors themselves, they have a very different perspective on the role of these tax subsidies. And here I have, as an example, legendary venture capitalist Alan Patrikoff, where Alan specifically says that QSBS encourages people to put money into startups for a very high loss factor. So I'm going to explain in detail in a moment what the QSBS program is, but it's a major federal level program in the United States that allows certain startup investments to not pay capital gain taxes. And what Alan is saying here is that when these subsidies are available, then investors pick riskier investments. That's exactly what we study here in this paper. In this paper, we consider this question using a sample of companies where their earlier investors all benefited from QSBS subsidies, such as Duolingo, Uber, Coinbase, Zoom, all companies in our sample and all companies that became very high profile firms, very big successes. But our sample also includes firms that, even though the investors were also eligible to these tax subsidies at inception, these companies became high profile failures, such as Terranos, Dricera. So using this sample that includes both high profile successes as well as high profile failures, in this paper, we formally ask whether tax subsidies affect not only the level of funding that goes into startups, but also investors' willingness to back riskier companies. We also consider that these startup investors, they have different organizational structures and incentive schemes, and therefore they may respond differently to tax policy. So, for example, should venture capitalists who invest outside capital and receive incentive-based compensation respond the same way to tax policy as angel investors who allocate their own capital? And finally, we ask through what mechanisms these incentives operate, if they only affect project selection, or if they also influence the way that investors keep and engage with their portfolio companies. In this paper, we start with a simple model, and we use this model to tease out differences across investor types, specifically to explain how different investor types select investments when these tax subsidies are available. Then we test the prediction of the model empirically using detailed data at the investor firm level, and I'll cover all of that in detail in a moment, but I'm going to start by characterizing the significant tax program that we use for identification in our paper. So in our paper, we use the QSBS program, which I started describing a couple of slides back. QSBS stands for Qualified Small Business Stocks. It's a major federal level program in the United States that allows certain startup investments to not pay capital gain taxes. But not all investments qualify for QSBS. To qualify for QSBS, a portfolio company must be a C corporation with total assets under $50 million before and immediately after the funding by the investor. Portfolio company must also be operating in specific sectors of the economy, including technology, biotech, manufacturing, but excluding service-based industries such as healthcare services and hospitality. And finally, there's a 5-year holding period that is required for these investments. If any of these conditions are violated, then the investment does not qualify for QSBS. But if all conditions are met, then investors can exclude capital gain taxes on the maximum of 10 times the initial investment or $10 million. So for instance, if an investor allocates $20 million into a QSBS eligible startup, that particular investment can generate up to $200 million in gains in which the investor does not have to pay capital gain taxes on. That's basically the idea. And this program was originally introduced in the United States in 1993 and was originally designed to cut in half the federal capital gain tax rate, which was 28% at the time. But over time, it became less attractive to investors until it was enhanced in 2009 and in 2010. To illustrate these changes over time, I have here in this figure in blue color the regular rate for capital gains at the federal level in the United States. And you can see that over time it declined from 28 to 20 to 15%. And what happened is that the rate for QSBS eligible investments remained flat at 14%. So as a result, the subsidy that is effectively provided by the program over time declined from 14 to 6, just 1 percentage point, becoming irrelevant for investors. So in 2009, as part of the American Recovery and Reinvestment Act, the government increased the subsidy provided by QSBS to 75%, the regular rate. And in 2010, it completely eliminated taxation on QSBS eligible investments. So as a result, any investment started after 2010 and held for 5 years or longer could benefit from full benefits of QSBS, which are quite substantial. So if you see, for example, based on post-2015 tax rates, we're basically saying that investors avoid paying about 25% of their gains if the investment qualifies for QSBS. And there's more, because this is just at the federal level. And most states also comply with QSBS at the state level, where the average capital gain tax rate is 7%. So when you combine federal level and state level capital gain taxes, investors basically avoid paying about a third of their gains if the investment qualifies for QSBS. So I mentioned that we have a simple model in the paper to explain how different investor types select investments when these tax subsidies are available. When you talk about the investor types in this market, we're mainly talking about VCs, angel, and corporate venture capital arms. They represent over 80% of the capital that flows into QSBS eligible firms. But these investors are fundamentally different when it comes to the source of capital that they invest, the way that they are paid, and even the tax that they're exposed to. So what we do here in this model is we model the salient differences in a dynamic framework, is specifically a real options framework where investors that choose to invest, that particular investment generates a cash flow X that is a function of a growth rate, is a function of the project volatility, and it also includes a Poisson jump that represents the rate in which firms suddenly go out of business, which is quite often in the VC-backed markets. This is the cash flow for any given investment, but then each investor has his own payoff function. And when we consider these different investor types, the most interesting investor types for the purposes of our model is venture capitalists. The key feature of how fund managers within VC firms work is that the general partners, which are the fund managers or GPs, they make investment decisions after external investors, which are limited partners or LPs, allocate capital into a VC fund. And the way that the GPs get compensated is the following. So first, nearly 100% of the funds that they invest comes from limited partners. The LPs, they get their money back plus a hurdle rate, which is usually 8%. And anything that exceeds this hurdle rate is shared between GPs and LPs, where GPs keep 20%, LPs keep 80%, and even if GPs don't make any profits exceeding the hurdle rate, they still keep a 2% management fee. So the key insight is that these features of the GP compensation structure create a convex option-like payoff function for VCs. They have very limited exposure to losses since they invest outside capital, but they share profits exceeding the hurdle rate, which become even larger when these tax subsidies are available. We also consider in our model, specifically in the payoff function of VCs, factors that go against an increase in risk-taking by VCs, even when tax subsidies are available. And the most important factor that we have here is career costs, which is basically the idea that it is very challenging for a VC to raise a subsequent fund when a current fund is performing poorly. That matters a lot since they have to raise new funds every 2 to 3 years so that the firm continues to operate. And there's also co-investment. So nearly 100% of the funds invested comes from limited partners, but GPs do put 1 to 2% out of their own pocket. So they have a little bit of skin in the game. But for angel investors, that's very different because they have 100% of skin in the game. They do not raise external LP capital. They only invest their own money. So they're completely exposed to gains and to losses. They have a linear payoff function. And it's a similar situation for corporate venture capital arms. When we talk about corporate VCs, they do not raise external LP capital. They only invest out of the corporation's balance sheet. But the distinction here is that they're exposed to corporate income taxes instead of capital gain taxes. So we don't expect corporate VC arms to change the way they select investments when capital gain tax subsidies become available. The key prediction that yields from our model is that these tax subsidies, they increase risk-taking in project selection, especially for venture capitalists. And that's precisely because of these features of the GP compensation structure that I just described, and that's even after accounting for factors that would go against an increase in risk-taking by venture capitalists. But to make this prediction more intuitive, we calibrate the functions of our model. And then here we have two 3D figures, one that is for VC firms and another that is for angel investors. In both figures, in the vertical axis, we have investment thresholds, which are minimum expected cash flows to trigger an option to invest by an investor. So lower thresholds means that more marginal ventures are going to be funded. And we model these thresholds as a function of capital gain taxes and project volatility, or the risk proxy for a given investment opportunity. And you can see here very clearly that as these capital gain taxes reduce, the investment thresholds also reduce. But you can see that this change is much more pronounced for VCs and especially for riskier investments. You can see that project volatility interacts with capital gain taxes to reduce these investment thresholds. So we test these predictions from our model empirically using the enhancement of QSBS in 2009 and 2010 for identification, and using data from PitchBook, where we track investments by VCs, angel, and corporate investors between 2004 and 2022. And based on the QSBS criteria that I described earlier, we identify and track 39,000 unique investors and 35,000 unique portfolio companies. And we track each investor for impairing over time, 158,000 in total, from the initial investment by the investor until that particular investor completely exits the position in the portfolio company. And the first question that we ask using this data is whether investors engage in strategic timing to qualify for QSBS subsidies. So here we consider only investments that otherwise qualify for QSBS, depending on how long the investment is held for. And then we see the extent to which there is any clustering at this 5-year holding requirement for QSBS qualification. So when you consider the distribution of investment holding periods, you can see that before 2009, there's nothing special going on at the 5-year holding mark. But after 2009, you can see that there is a clustering at the 5-year mark. There's also a whole change in the profile of this position, where investments that before QSBS benefits became available would be held for longer and now disposed more quickly once these benefits become available. But that's just suggestive evidence in the raw statistics. To formally estimate the elasticity of investment to tax subsidies, we use bunching methods. And what we find using bunching is that for QSBS eligible investments after 2009, there is an elasticity point estimate of 4.45. What this 4.45 elasticity means is that for each percentage point of tax subsidy, there is an increase in the mass of investors exiting exactly at year 5 by 4.45%. So it's a very substantial elasticity. But it will be reassuring to see lower elasticities for periods when these tax subsidies are unavailable. So either eligible sector investments before 2009 or ineligible sector investments before and after. So we look into this, and consistently for our priors, we do find lower elasticities for these investments, which in a most simplistic interpretation would represent the natural preference to hold these investments for 5 years in the absence of tax subsidies. So in the paper, we go a step further, and we employ a method called differencing bunching, where we net out from the 4.45 each of these differences to get to a clean elasticity range that is specifically attributable to tax subsidies. So these initial results tell us that investors do engage in strategic timing to qualify for QSBS subsidies. Next, we look into what we're most interested in, which is risk-taking at the project selection stage. We do so using a difference in differences framework, where we estimate separately for VCs, angel, and corporate investors the following regression equation. Coefficient of interest here is beta 1, which is the interaction between the portfolio company being part of an eligible sector and receiving funding from that particular investor after 2009 when tax subsidies became available. And here we employ a strict set of fixed effects to ensure that confounders are not driving any any results that we find. What we find from these tests is that when and where tax subsidies are available, VCs change project selection by backing riskier companies. And that's across a number of dimensions. So first, they are more likely to back companies that are still at the pre-commercial stage, more likely to back companies that carry pre-existing debt, more likely to back companies that are based in other states where monitoring is harder or at least more costly, more likely to back companies that are part of industries in which they have no prior experience investing, more likely to provide a startup's first funding, and finally, less likely to syndicate these investments with other investors. And what is even more interesting is that all these patterns that I describe here are exclusive to VCs. None of these patterns appear to either angel investors who are subject to exactly the same QSBS subsidies as VCs, or to corporate investors who are subject to a different tax scheme. And a natural question that emerges when we see these results here is, okay, so VCs engaging greater risk-taking, but what's the outcome of these investments? So analyze the performance outcome of these investments by tracking them over time until they are exited by investors. And here we use a triple differences framework where we exploit three features of QSBS. We consider not only industry eligibility and whether the investment was started before or after 2009, but also whether the investment was held for the mandatory 5-year holding period for QSBS qualification. Again, here we employ a strict set of fixed effects to ensure that confounders are not driving our results. So here we have investor firm pairing, fixed effects, year fixed effects, and holding period fixed effects. So in this case, we're estimating this big regression equation over here, where beta 1 is the coefficient of interest. So the triple interaction coefficient of industry eligibility, holding for at least 5 years, and investment entry after 2009 when QSBS subsidies became available. So in these tests, what we find is the following. So for VC-backed QSBS eligible investments, we first see a higher rate of business failures, which is somewhat expected, right? So there's more risk-taking at the project selection stage, so more of these businesses go out of business. But what is interesting is that we also see an increase in the likelihood that these investments achieve unicorn status. So when we consider the return distribution of a VC fund, they are increasing both tails of the distribution. There are more complete failure of these investments, but also more unicorn exceptional outcome for these investments. And again, these patterns are exclusive to VCs. They don't appear to either angel or corporate investors. We conduct a number of extensions and robustness tests in the paper that I'm not going to have time to cover. But the only thing that I want to mention is that these results do hold when we use predicted holding periods instead of actual holding periods. So predicted holding periods based on pre-2009 fundamentals of each investment. Results that we see here also hold. So to summarize and conclude for today, in this paper, we mainly ask whether tax incentives affect investors' willingness to back riskier companies. We do so in a setting where the startup investors, instead of the startups directly, they receive these tax subsidies. We consider that these startup investors, they have different organizational structures and incentive schemes, and therefore they may respond differently to tax policy. So we propose a simple model to tease out differences across investor types in terms of what investments they select when tax subsidies are available. We test the predictions of the model using detailed data at the investor firm level and using the QSBS enhancement in 2009 and 2010 for identification. And we find that when and where these tax subsidies are available, VCs change project selection by backing riskier companies, which generate both higher rates of failure as well as higher rates of unicorn outcomes. So that's what I had for today. Thank you all so much again for the opportunity to present.